Big changes are coming to your retirement accounts next year, and whether you're contributing to a 401k, 403b, 457, IRA, or HSA, you'll want to know what these mean for your money. I'm also going to cover a few important updates from recent years that many people have missed. So let's dive into what's changing and how you can make the most of it. Before I go into these changes, here's a quick look at the recently released tax brackets for 2025, along with the standard deductions. These are important to know because every dollar you pull from certain retirement accounts, like a 401k or traditional IRA, gets taxed as regular income. So understanding where you fall in these tax brackets can help you plan for withdrawals that keep your tax bill low and make your retirement savings go further. At the time of recording this video, these tax brackets are expected to expire starting in 2026. But the recent presidential election happened, so we might actually see them get extended. Just keep an eye out over the next year or so, because if they do happen to revert back to something like pre-2018, then you might want to think through if it would make sense to make some sort of conversion. We're going to knock out the changes one by one based on account type, so let's start with 401ks, 403bs, and 457s. Starting in 2025, there will be auto enrollment into 401ks and 403bs for new hires. It'll start with a minimum 3% contribution rate, but the employer can choose to increase the auto enrollment amount up to 10%. Some employers may have already put this in place, but January 1st of 2025 is the deadline for it to be implemented for everyone. Plans with auto enrollment will not only start employees at a default contribution rate, but will also automatically increase their contributions by 1% each year. This increase continues until the contribution rate hits the employer's set maximum, which is between 10% and 15%. Employees can choose to turn off or adjust their rate, but the annual 1% increase will apply until the cap is reached. I love these new features to retirement accounts because behavioral research has shown that automatically opting people into retirement plans gives a major boost to participation rates and savings. This is because many people stick with default options, so if you can make the default option to be automatically opted into something, then they'll be less likely to take the extra step to opt out. Stack the auto escalation feature on top of automatic enrollment, and future generations are going to be way better prepared for retirement, which is always a win. Based on research, the only other way to improve this even more is to offer some sort of financial education so these people understand the benefits, which will make them less likely to opt out. 401k, 403b, and 457 individual contribution limits will increase from $23,000 to $23,500. According to Vanguard research, only about 14% of people actually max their accounts out every year, but it's still important to know for those super savers out there. Catch-up contributions are where we see the new rule changes. In the past, catch-up contributions were the same amount for people 50 and older, but starting in 2025, for people 50 to 59, they get a catch-up contribution of up to $7,500, which will increase their total amount to be able to contribute to $31,000. People 60 through 63 get access to a higher amount based on the new rules. They're actually able to make catch-up contributions of up to $11,250, which increases the total amount they can contribute for the year to $34,750. One thing to note is that this new catch-up contribution limit increase for people 60 through 63 is optional based on if your employer wants to offer it. If yours doesn't, then it might be something worth reaching out to your benefits department to ask about. Quick reminder that any match you receive from your employer does not count towards these individual contribution limits. This won't go into effect until 2026, but I wanted to mention it right now because it's partly based on 2025 income. If you're 50 or older, 401k, 403b, and 457 catch-up contributions must be made to the Roth side of things if your wages are greater than $145,000 in the previous year. So if in 2025 you earn more than this amount, then in 2026 your catch-up contributions will all have to go towards Roth. If it's below that, then you can choose between Roth or pre-tax. The IRS is making this a mandatory change, so your employer will be forced to implement it. Expect the $145,000 amount to increase slightly every year once it goes into effect in 2026 due to how inflation is indexed. Help support my little dog Molly as well as this channel by hitting that like button. Part-time employees will now have access to 401k plans through their employer starting in 2025. They call these people long-term part-time employees. To be eligible, you must work 1,000 hours in a year or 2 consecutive years of service where the employee completes at least 500 hours of work in a 12-month period. Keep in mind that if you work 2 jobs and enroll and contribute to 2 401k plans, you must keep your total annual contributions to no more than the yearly limit we just talked about in the previous section. For instance, in 2025, the 401k contribution limit is $23,500. So if you contribute, say, $10,500 to Plan A, you can only contribute $13,000 to Plan B, since that combined total reaches the maximum allowed to contribute for that year. Don't forget that IRAs have always been available to part-time people who have earned income, and there's no work hour requirement to contribute to that account. Speaking of IRAs, in 2025, the Roth IRA contribution phase-out range for single filers and heads of household will extend from $150,000 to $165,000. This means individuals with incomes between $150K and $165K can make reduced contributions, while those earning above this limit will not be eligible to contribute directly to a Roth IRA, but they can still do a backdoor Roth contribution. For married couples filing jointly, the phase-out range has also risen, now covering incomes between $236,000 and $246,000. Unfortunately, the limit on annual contributions to an IRA in 2025 stays at $7,000. The IRA catch-up contribution limit for individuals ages 50 and older also stayed at $1,000. There are 2 new 10-year rules with inherited IRAs that start in 2025. First, you used to be able to stretch out withdrawals from an inherited IRA over your lifetime to minimize the taxes you paid. But of course, the government cannot control their spending, so they need to get their grubby little hands on these tax dollars sooner rather than later, which means the new rule requires that most non-spousal beneficiaries who inherit an IRA from someone who passed away on or after January 1st of 2020 must withdraw all money in the account within 10 years of the original owner's death. The second part of this has to do with how you distribute money from this inherited IRA over those 10 years. If the person you inherited the IRA from wasn't yet taking required minimum distributions from the account, then you can withdraw money in any increment at any time as long as the account is empty by the end of the 10th year. If the original owner was at the age to where they had to take RMDs, then you have to continue taking those RMDs during those 10 years and have this account completely depleted by the 10th year. So there's a little less flexibility with this one. The last big change for 2025 are the contribution limits for a health savings account. The contribution limit for the year has increased to $4,300 for individuals and $8,550 for family coverage. Catch-up contributions for people 55 and older has stayed the same at $1,000. If you want to know more about what an HSA is and how to supercharge the account, then I'll have my video on the topic linked above my head and down in the description below. Okay, so those are all of the major changes coming to your retirement accounts in 2025. But there were also a lot of changes that happened back in 2023 and 2024 that some of you might not be aware of. So I want to quickly touch on some of the more important ones that you should know about. One that went into effect in 2023 but many aren't aware of is that if your employer allows it, then you can choose to put some or all of your employer match into the Roth side of a 401k, 403b, and 457. Previously, all employer matches had to be put into the pre-tax side, but this isn't the case anymore as long as your employer offers it, since this is optional. Keep in mind that if this matching contribution is put into a Roth account, then it's treated like taxable income, so you will need to pay taxes on it for the year that the contribution is made. Your employer will give you Form 1099-R showing it as income for that year. You'll either need to adjust your tax withholdings so more is taken out to cover the tax on this additional income, or pay for the taxes when you file your return for that year. Since this feature is optional, if your employer doesn't offer it but you are interested, it may be worth reaching out to your benefits department to request it. The required minimum distribution age increased from 72 to 73. They also reduced the tax for failure to take an RMD from 50% down to 25%. For those of us who are younger and further away from retirement, in 2033, this RMD age will increase again to 75. Another change is with RMDs and Roth 401ks, 403bs, and 457s. In the past, you were forced to take them when you had money in the Roth side of these accounts, but starting in 2024, they're no longer required. In 2024, there was a change to RMDs for 401ks, 403bs, and 457s when it comes to surviving spouses. Previously, if a spouse inherited a retirement account, they would generally have to begin taking required minimum distributions soon after their spouse's death, even if the person deceased had not reached RMD age. Under the new rule, a spousal beneficiary who's the sole inheritor can now choose to delay the first RMD until the year the deceased spouse would have turned 73 or 75 starting in 2033. The surviving spouse can also use the more favorable uniform lifetime table to calculate RMDs instead of the single life table, which typically results in lower RMDs. This adjustment allows the surviving spouse to stretch out distributions and preserve more of the account's value over time. There's a new rule with 529 plans if the beneficiary doesn't end up using all of the money in the account for its stated educational purposes. The new 529 to Roth IRA rollover rule allows you to transfer up to $35,000 in a lifetime from a 529 college savings plan to a Roth IRA in the same person's name as long as the following three conditions are met. First, the 529 plan must have been opened for at least 15 years with the same beneficiary. So for those of you with kids, get a 529 opened as soon as possible and put at least a little bit of money into the account to start getting this clock ticking. Second, any contributions made within the last 5 years before the rollover are ineligible for rollover. Third, the rollover amount cannot exceed the annual Roth IRA contribution limit. This limit includes any other contributions the beneficiary makes to their Roth IRA that year. On screen, you can see an example of how much can be rolled over every year if we assume that the beneficiary has $30,000 in their 529 and roll over the maximum contribution limit every year if the max contribution allowed in a Roth IRA is $7,000 per year. Another good thing about this is that it's exempt from Roth IRA income limits. Normally, if you earn over a certain income threshold like we talked about earlier in the video, you cannot contribute directly to a Roth IRA. This rule, however, allows the rollover even if the beneficiary's income is over the limit. Starting in 2024, employers can help employees save for retirement while they're paying off student loans. Here's how it works. When employees make payments towards their student loans, employers can match those payments by contributing an equal amount to the employee's retirement account, like a 401k, 403b, and 457. Even though the employee isn't contributing directly to the retirement plan. As with some of these other changes, this is optional, so your employer doesn't have to offer it, but it's helpful if they do. Starting in 2024, a new rule allows people with 401ks, 403bs, and 457 retirement plans to withdraw up to $1,000 per year for emergency expenses without paying the usual 10% early withdrawal penalty. The catch to this is that after one emergency withdrawal, you won't be able to take another one for the next 3 years unless you repay the amount or contribute an equivalent amount to that plan. Remember that retirement accounts aren't made to be used to pay for emergencies. That's what emergency funds outside of retirement accounts are there for. Try to avoid making the mistake of pulling money out of an account like a 401k, 403b, or 457 if possible. If you want to know some other 401k mistakes to avoid, then you can watch this video to your left next. Hit that like button before you go. I'll see you in the next one, friends. Done.